Alright guys, welcome back to the channel. So in this video we're going to be talking about institutional stop hunts and why you keep getting stopped out around support and resistance and various other price patterns. So this video is going to be a follow-on from the video that I did on liquidity a few months back, and it's just going to continue on from that concept of liquidity and how and why you may be getting stopped out of some of your position. So understanding and noticing these concepts was very profound to me once I started going back on some things that I've been testing, and I thought, well, why did this trade lose? What happened here? Why are the markets moving? How are they moving? And how does this correspond to my winners and my losers, right? So just bear in mind, right, we're on the Euro US dollar on the 1 hour time frame, but these principles, these concepts, they work on any market, any time frame, right? It's just going to be down to whatever you can be the most consistent with. So following on from the video that I did about liquidity, we understand that if we want to, let's say in this case, we want to sell, we need people on the other side of that transaction who are willing to buy. And on the flip side, right, if we want to buy, we're going to need people on the opposite side of our transaction who are willing to sell. So how can we use this information to our advantage to stay out of stop hunts, right? So let's just take this example here. We've got price pushing up into this level, and if we was to just ping a line here, right, we can see that we have got a nice level of resistance. We've hit this level, resisted, hit this level and resisted, and put in a nice double top. We've got structure there, structure, right, structure, and again, if we was to scroll out, we've probably got multiple tests of this level. So 100 out of 100 traders are going to look at this level and probably think that this is likely to hold here, right? And I wouldn't necessarily disagree. However, what we've got to understand is that in this situation, if you've got a lot of traders that are looking at this level to take a short, what have we got above here, right? We've got people that want to sell this market, okay, wherever the stops and targets are going. We've got people that want to sell this market with their stop losses above here. And we've also got people that are most likely looking at this on a lower time frame, if we drop down to a 15-minute time frame, that are noticing this pattern play out, which is a bullish pattern. So traders expecting this to do something like this and then break out to the upside. And with that being the case, most likely having buy orders above this level, waiting for a break of this resistance, right? So they'll most probably have buy orders above there looking for some sort of higher level, right? So what does this tell us? We've got buy orders above this level, okay, from the stop losses of the sellers, okay, there's going to be a load of buy orders here, and there's going to be a load of buy orders here from the breakout traders, right? So ultimately we've got liquidity at this level. Again, going back to the video that I did on liquidity, right? If we want to sell, we need people that are willing to buy, and we've already established that there is a lot of buy orders above here. So what do I need the price to do if I am a banker? Right, I need to run price into this level so that I collect all the buy orders. There's loads of people buying through stop losses or the breakout traders, loads of buy orders, so that I can then accumulate my sell position, right, or get into my sell position to then take this market lower. So what actually happens here? Now, the way that banks trade is a lot different from the way that we trade as retail traders. So a good thing to remember is banks buy to sell and sell to buy. So banks buy into liquidity, and once they've taken the liquidity or they've got enough liquidity to accumulate their sell orders, right, they will sell the market, okay? So then banks sell. Banks buy into liquidity, and then once they run liquidity, they sell off. And when this happens, this move here is called an order block. Okay, so what can we take from this order block, right? So as price starts to travel down, we can assume that around this area, banks have heavily positive sell positions. So as they start to get out of their positions, right, and the market starts to move higher, we can also assume that they have also got heavily negative buys from when they started to buy in at this position. Okay, so now we're out of our sell positions, right? So we're out of our sell positions for a profit. However, we've still got these negative buys. Now, why wouldn't we have a stop loss here if we was a bank? Obviously, if we've brought into this position, a retail trader would usually have a stop loss below this level. However, a stop loss would indicate that we want to get out of the market all at once, right? The same as if we was to buy in all at once. And we already know that if that was the case, then the market would move against us significantly. So as the banks start to sell out of their position and the price starts to raise back up to this level where the buying pressure began, the banks then mitigate out of their negative buys. okay? And mitigation by definition just means to reduce the severity of something, and obviously the severity being their negative bias. So obviously they've brought into this position to take the liquidity so they can take the market lower, but they have still got the negative bias. So as the market comes back into this area where the buying pressure began, they start to unload on their buy positions, right? And the market begins to drop off from this level. Now we can see this happen time after time, right? So even in a situation like this here, right, we've got nice support. We've got a nice level of support. It gets respected, and as you can see, bang, right? We drop below, and then we start to push up. Now, not every area that you see, this isn't going to be the case in every single area. But we can see a similar situation here, right? If we was to move this horizontal line down here, okay, and we can assume that this is quite a nice level, right? Look, we've got support there, right? If we look left, we've got a nice level of support here. And this looks like a good level to buy. And had you tested this and you came back positive with solid rules of engagement that you are consistent with and disciplined with, and you've got a positive expectancy, I would agree. However, looking back in your losers, what happens in a lot of your losers? Because I'd imagine you'll quite often see something like this, right? Even though that you're right about this level holding, you'll most likely see some sort of manipulation of this level and then a push higher, right? But what is happening when that happens? So we've got a load of people, again, 100 out of 100 traders at this point are most likely going to see this level of resistance, right, this level of support, and think, right, I want to buy here, get my stops below these lows, okay, and I'm going to shoot for this level. Again, not necessarily a bad trading opportunity, right? However, you need to be aware of, you know, if you can see it, then the banks can see it. Loads of other people can see it. There's going to be so many resting orders underneath this level, right? And obviously we know that price is drawn to areas of liquidity. So what happens here? We start to get selling pressure in and around this level, right? That takes price lower. And again, we've got loads of orders below here. Again, opposite orders from the sellers that are looking for a break of this level to take this lower, because on a lower time frame, what have we done here? We've broken and closed below this support. You can see that there's most likely, get rid of this, you can see that there's most likely a lot of traders that are looking at this and have started to sell. Okay, so you've got loads of sell orders now coming in from traders that are like, right, we've broken and closed below this support, let's sell, 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 sell. So what do banks need if they want to buy this market up? They need sellers, right? So what can we assume has happened at this level? We can assume that banks have started to sell into liquidity, right? And as the liquidity gets run, what can we assume starts to happen in this area? We can assume that the banks have started to accumulate their buy positions, right? So banks sell to buy and buy to sell, right? Just as everybody is looking bearish on this pair, the banks say no, bang, start to buy in heavily at this level. Now as we mark up, we can see that if we was to buy down here, right, in and around this level, that we have got heavily positive buys at this level. So obviously we want to not just sell out of our buy positions all at once, but we want to distribute out of our buy positions, okay? So we want to, if we're a bank, we don't want to just sell out of our positions all at once, because again, we're just going to move the market. However, once we do that, we've still got negative sells, right? So after we've accumulated out of our buy positions, we can assume that banks are going to need to return to, you know, this level, or even you could make an argument that there was some liquidity generated down here that got ran, okay, to mitigate out of our positions. If we ask ourselves, right, where did the selling pressure start? Well, for me, the selling pressure started there, right, when we started to sell off down into this, past this structure zone, right? So this, for me, is my order block. Now, some people say that it's the last down candle before the up move, and in a lot of cases that is the case, but I think it really, what you've got to remember is price is very fractal. So on the 1 hour time frame, right, this is the last down candle before the up move. However, if you was to keep dropping down to the lower time frames, there's going to be more down candles before the up moves, right? And to be fair, if you was to drop out to the 4 hour time frame, you could even make the case that this is your order block here, right? Because obviously we've got equal lows being generated here in the form of this resistance. We start to sell down past it, and then we push up. However, for me, I'd class the start of the order block, right, at this level here. Okay, as we start to push down into this level, this is where I'd start to be looking for the mitigation if I was taking this approach to this trading opportunity. Again, we've still got negative sells, okay, in this position. So we've accumulated our buy, we've bought into this market, right? We're out of our buy positions, okay, which is this type of consolidation here. Right, this is the banks moving the price backwards and forwards, getting out of the sell positions, and they've still got negative sells. And where does price return to? Right, we return back down into this level to mitigate out of our old positions, right? So that isn't the cleanest example. It's one that I've just pulled off of the Euro US dollar because it's just happened. But if we go to any market, any time frame, right, we can see it happen anywhere, right? Again, if we was to look here, right, what's happened here? We've got support that's holding, and then bang, we push up and then get a sharp push down, right? So what can we assume is above here? We've got liquidity above here that gets ran, start buying into the liquidity, and then bang. But where do we start buying? We start buying around this level. This is where the buying pressure really starts to take off. And if we was to bring on something like our RSI here, you can most likely see we've got some divergence on the RSI after we break these equal highs, right? So as we break these equal highs and we get a strong push up, we're actually making these highs on less strength. And a lot of the time when you see this type of move happen, you get divergence on the RSI that breaks these equal highs. So we get equal highs that get broken with divergence on the RSI. And then we see a strong push to the downside. So again, getting out of the sell positions, right? And then as the price runs up back into this level where the buying pressure started, so that the banks can then mitigate out of their positions, right? Again, a very similar sort of situation here, right? If we're just looking to the left, okay, so we've got equal lows being generated, which then get ran. Okay, so we can assume that the banks started selling here, right? And then as they buy, they've still got the negative sells. So price returns to this level so that the banks can mitigate out of their sell positions, and then the price continues higher. Similar situation here. Okay, so we sell down into this level, grab the liquidity from below here. We see price remain higher, and as the banks start to unload their positions and price returns down to the level, down to this mitigation level, we see a nice strong push higher, right? So a very similar situation here, right? Look, we've got equal highs, okay? And then as we get the push up, right, the price action's making high highs, and then the RSI is making lower highs. Now, a lot of people, you hear them say, oh, the RSI doesn't work and things like that, right? But it's just knowing what the indicators are telling you, what they're used for, and how to use that in conjunction with price action, okay? Just trading off of indicators or trading off of moving averages isn't always, like, you're right, there is better ways to trade and to understand what the market is doing, okay? But understanding why you use these indicators and what they're telling you in conjunction with price action can be very powerful. So don't dismiss it unless you fully understand what it's for and you've tested it and you've got the raw data to back it up or disprove it, right? And again, this is going to be down to the trader's own discretion, okay? If you haven't learned the right way or you don't understand how and why you're using it and you're just throwing these things on your chart because you've seen someone else do it or you're just taking someone else's word for it, then you're going to have a hard time with any style of trading, whether you're trading algorithmically, whether you're trading through support and resistance, smart money concepts, whether you're trading advanced patterns, whatever route you decide to go down, right, you're going to need to be able to do your own due diligence, your own testing to back up what you're being told, right? Alright, so I hope that made sense. I hope you understand market manipulation a little bit better now, institutional stop hunts. You understand how the institutions like to, you know, run levels to take your liquidity. I hope you understand why that happens, right? And who is behind the moves in the market. And understanding that and knowing that can better help you prepare for trading setups and take advantage of these moves when you see it happen, right? So I hope you got value from that. If you did, make sure to hit the like button and subscribe for similar content. And wherever you are in your trading journey, I hope you have a good week, and I'll see you on the next one.